Welcome back to TradingProbability.com. In this video I'd like to tell you the real reasons how and why a price moves. This has nothing to do with moving averages, Bollinger Bands or RSI. This is the real market mechanics in action. Price movements happen because of the aggressiveness and passiveness of both buyers and sellers, as well as supply and demand. But more on that in a minute. Let's get started. We're going to have a look at why prices go up in a marketplace. The first reason is that buyers are more aggressive than sellers. You may have heard that prices go up because there are more buyers than sellers, and that can be true, but if there are 1,000 people wanting to buy and one person wanting to sell, what happens if all 1,000 buyers don't want to buy at the seller's price? The market won't move. Buyers need to be willing to pay up into the seller's price. That is what will cause the markets to move and cause price changes. On the right of the screen, we can see a depth of market, also called a DOM. The DOM can be thought of as a look inside of the market. The number running along the middle of the DOM is the price, with the current price being 159.46. The columns labelled buy and sell are the limit orders currently in the market. A limit order is what is known as a passive order. If you set a buy limit, you want to buy at that price and that price only. Compare this to a buy market order, which is aggressive. You're prepared to buy it at whatever the current price is. We can see that 396 contracts are currently sitting on the bid at 159.45. This means there are 396 contracts which are buy limit orders. We can also see that there are 111 sell limit orders on the offer. In order for price to move up from 46 to 47, at least 111 contracts will need to be bought at market. If an aggressive buyer bought 1,000 contracts at market, price would move up to 159.48. The buyer would end up with all of the 111 contracts from 159.46, all 474 contracts from 159.47, and 415 out of the 454 contracts at 159.48. This leaves 159.48 with just 39 contracts waiting to be sold. As we can see here, it's the aggressive party which caused the price movement. Market orders can be people getting into the market, initiating a position, or they can be people getting out of the market, such as stop loss orders. But how does this relate to supply and demand? We've just seen that demand has overwhelmed the supply of the market. The trader buying 1,000 contracts has just completely taken the supply from almost 3 prices. But let's have a look at this in relation to a chart and a support and resistance framework. Here we have a plain price chart. No fancy indicators, just price. But where on the chart are people looking at buying? It's there, right? Look how strong this support is. There must be lots of demand at those prices. Look at how many people have bought it down there. But think for a moment where all of these buyers have put their stops to evacuate their buy positions. Think about what kind of order a stop loss is. A stop loss is a market order, remember? A market order doesn't care which price it sells at. It just sells whatever the current price is. If we've had a lot of buying at this so-called strong support, we must have lots of stop loss orders below. But also think about the breakout traders. You know the ones. They'll start selling as soon as we poke through that support. They probably have sell stop orders down there waiting for it. But here's what happened. The sell orders have all been triggered at once and the supply has overwhelmed the demand. There were simply not enough aggressive buyers down there. Then we have the previous buyers becoming aggressive sellers. Their stop loss orders have aggressively absorbed the passive buyers. But how do we react to this while on the sidelines? Well, this is just scratching the surface of how and why markets move. We've learned about the depth of market, supply and demand, and a little bit about support and resistance. In the coming videos, we'll be taking a deeper look at how we can profit off of these moves and spot these levels in real time. But be sure to subscribe to the channel and check out the blog at TradingProbability.com for more trading information and a daily chart outlook. Take care.